All right, so Bryn, I come to you first. So Jim's trying to get out the door before everybody else tries to get out the door. Tom Lee says, yeah, there's going to be a correction more than likely in 2022, but it's not going to happen until mid-year once the Fed actually starts to raise interest rates. Is Jim leaving too many things on the table by trying to take some profits now rather than ride the momentum or the fuel, as Tom Lee puts it?
Well, first of all, I think it's really hard to time. But Jim's talked about he's 100% invested in equities. So whereas I'm an asset allocator and we have diversified portfolios, Jim is all in on equities. And so if he thinks, that's the prudent thing to do, that's his prerogative. And I understand it. I do agree with Kevin, though. Sitting in cash is difficult because we always tell our investors there's two decisions to make. Selling is really easy because it feels good. And to Jim's point, the Nasdaq's done 20% per year for the last 10 years. The S&P, I think Jim said, has done 17% for the last 10 years. So mean reversion will definitely come into play. But I do think as an investor, you have to remember that second decision is so much harder when to get back in. And so, what we're doing in portfolios is, increasing our allocation to things like JEPI, which is a high-quality U.S. equity strategy that sells covered calls to take advantage of the volatility. And then also you collect that good income from those premiums. Because ultimately, all of us on the panel, our super weapons, our secret weapons, are time and patience. And I think next year is really going to call in that second super weapon of patience, because I do agree with Tom that the first half of the year, I think, is going to be choppy. I could easily think that the second half of the year are where we're back and loaded with returns, especially don't forget this is a midterm year. And when you look at presidential elections, that midterm year is typically the worst of those 4 years. And so I do think the Fed pulling back, the fiscal drag that we're going to see, I think that GDP is going to come down a lot more than people expect. And that's going to put the Fed in a tough position of being able to thread the needle of reducing inflation or trying to reduce inflation, but not slow the naturally slowing economy that I think is going to come our way in the second and third and fourth quarter of this year.
Okay. All right. The fair points, all, of course. Dr. J, this really is a conversation about momentum, right? We lost it, and now we have it back. And we have it firmly back, right? The question is, how long can we ride that momentum into the new year before we have to face some of the real serious issues, the likes of which Bryn talked about, and then ones that even escalate potentially later into 2022, midterm elections, maybe more Fed rate hikes, things like that?
Well, like most of the members, I like the second half of the year more than I like the first half, Judge. And one of the reasons for that is that we could see a 5,000 or 5,100 print in the first quarter. And if we do, I think that's going to contribute more to the choppiness. I think that means that, Jim, when that happens, Jim will be happy to spend some of that cash that he's raised. What I'm looking forward to, Judge, is the same thing that Bryn is, as far as that choppiness creates volatility. That volatility will pay me dividends by selling those pumped up calls against my other holdings. So I like that. I think as much as we're giving Jim a hard time about taking 10% off the table over, this period of time leading into the end of the year, I think Jay Powell's got a much tougher job than Jim Lebenthal does. I think Jim is doing what smart people do, take some money off the table, don't be a pig, all those sorts of things, Scott. But I think Jay Powell and the Fed, they know that the market reaction may be swift and very negative to the first moves that they make as far as raising rates. We already know they're tapering. Now as they start to raise rates, not in January, but as they get to that point, I think that's that volatility that we're all talking about. And I think that's much tougher. Go ahead.
No, but Doc, I'm confused, though, because it would seem to me that it should be exactly the opposite, that, you're more optimistic about the back half of 2022 when you have the potential of more turbulence than you will have in the first half. In the second half, we can have multiple rate hikes and the prospects of just the midterm elections in and of itself make people potentially uneasy and creates a little more volatility in the market. So why under that scenario would the market do better than in the first half, where you at least feel like you have a little bit of runway without the Fed getting in your face?
Well, to your point, Scott, I'm not the one raising cash, but I do see why Jim's doing it. I do think the Fed moves by April on the first rate hike. And so I think, like I say, that is that turbulence, that first rate hike. And yeah, by April. And then the second one, I mean, if we get another hot inflation number, Scott, I don't think they'll be able to just accelerate the taper any longer. I think they're going to actually have to move. And by then, they will have made several moves on the taper. We have several meetings between here and April. I think they will have plenty of time to both increase that taper and get us ready for that first jump, whether it's the end of April, Scott, or whether it's at the meeting at the beginning. I think either one of those, because I think they could do it in between meetings if they get a hot inflation read. And again, I think that's tough for Jay Powell and the Fed. That'll test their mettle again to see how much pain they're willing to watch in the market when that happens. And that will be a buying opportunity where Jim could commit capital.